Hello and welcome back to another week of your Mortgage Market Movers Weekly, where we are detailing everything that's going on in the macroeconomy to help you make better home buying decisions. This week's 30-year fix is sitting at a 6.11, so we finally climbed back up above that 6 range. Now, there's just so much that's been going on. I mean, we have geopolitical stuff going on with the U.S. and Iran. We also have FOMC coming up this week, Wednesday. So a ton to get into. We're going to dive into all of that once we get into the full episode. So let's hop right in to the charts. So we are at the U.S. 10-year, and it has just been such a crazy, volatile March. So the big thing was that the U.S. 10-year broke below 4, and last time it was below 4, it was back in November of 2025. So rates were coming down, right? When U.S. 10-year yield comes down, typically the interest rates also come down. Now, as of the end of February, the yield had finally broken down below a 4% floor. Now, as of March 2nd, just look at this. It quickly ramped right back up to 4.3. That's crazy. In the span of 11 days, it hopped up. And what happened over the weekend from Friday, February 27th to Monday, let's see, is this Monday? Yeah, Monday, March 2nd, was the announcement of war with Iran. I don't know if it was an actual announcement, but it was a strike. So war started. Now, that is not great for the stability of the market. And it's really not great for where we want to be inflation-wise, specifically with Iran. I think we talked about this, not last week because we missed a week, but week before that, we were really watching oil. And that has just been such a headache when trying to figure out what's going on with the interest rates and what is going on with the market as a whole. Oil is the key to understanding what's going on. So, because we struck Iran and took out their supreme leader, they closed the Strait of Hormuz. The Strait of Hormuz has 20% of global oil travel through it every single day. I think there's been some developments since then. I believe Iran said countries other than the U.S. or Israel can come through, but they have to pay in Chinese yuan. So it seems like there's been some progress, and oil exploded. I mean, it's crazy. Let's take a look and see. Let's see how we can find this. Do they do it like this? Yeah. Okay. So when we look, this is oil, and we can see, so March, it jumped from, and it had been in this range of like about 70 to, let's say, like mid 50s for crude oil. All right, looking at that. Now, it exploded up all the way to $120. And this is for a barrel, right? Let's see, when was the last time it was that high? In 2022. Okay, so last time oil got that high was 2022. That's really bad for inflation. When oil is that high, obviously gasoline prices go up, but inflation as a whole just it can jump like crazy. So that was the culprit for the U.S. 10-year really just climbing up, okay? And the reason for that is, like I said, we need to look at inflation. We had to see, are people going to want to buy bonds, which they need to buy bonds for the 10-year yield to come down? Are they going to want to buy bonds when inflation is very high, and it's expected to be high in the future? They're going to need a higher yield in order to store away their money, which is going to have less buying power in the future, right? So that's why I've been saying inflation is the key to all of this. And looking at oil, it's a terrible look for the inflation story right now. So really, I mean, hopefully oil can come down, but until there's some resolution with this, I mean, oil is just, it's so high right now. The U.S. has looked at releasing oil reserves, but to my understanding, I mean, that's a that's like a Band-Aid. That's like slapping like a Band-Aid over, I don't know, like a broken leg or something. Like that's really not fixing the problem at all. I think the U.S. government has even proposed trading oil futures, which we don't have to get into what futures are, but essentially trading commodities. And I mean, that is in and of itself, it'd be terrible. All right. That's not what we want. What we want is for resolution with Iran, the Strait of Hormuz to open up and oil to come back down, inflation to hopefully come down, and not have negative side effects that we feel for months and months. And that would hopefully bring the 10-year yield down. So let's get on over to the calendar. And when we look at this week, let's see, anything. So last week we did have some interesting data. We had CPI. So on the consumer level, inflation was as expected. Okay? Month over month, core, and year over year. Completely as expected. When we go to what else was interesting? PCE, as expected. GDP was not good. Quarter over quarter, 0.7 and expected 1.4. Missed the mark a good bit. We had jolts in this. So let's see, job openings, more job openings. So that was good. And the University of Michigan consumer sentiment was actually pretty decent, with decent inflation expectations. I would imagine. Well, I don't know when they do this. I don't know when they actually did this, but I would imagine that inflation expectations will probably be higher. Really hoping that this oil thing is more transitory. This week we have, let's see, tomorrow ADP weekly employment change, pending home sales. That's interesting for us, so we'll keep an eye on that. Tuesday, March 17th. We have Wednesday, March 18th, PPI. So from the producer side of things, how's inflation looking? We also have FOMC on March 18th. Now, let's just go and take a look at the probabilities. Probabilities. 99.1% chance of a pause. And when we had been looking at the Fed Watch tool, and it was pricing in 2 rate cuts this year. And, rate cuts, they aren't be all end all for mortgage interest rates. I definitely think we should be looking at inflation, but I think that it is important to look at this to see what the Fed is thinking about inflation for the future. And if inflation is not ticking down, rate cuts probably won't happen. So we were pricing in 2 rate cuts. That has shifted to 1 at the very end of the year in December. That's a 40% chance. Everything else is more than likely going to be a pause. So this FOMC, we get, of course, the decision, more than likely a pause. But we also get a summary of economic projections. That'll be interesting to see what the Fed's outlook is, and if they mention anything about oil and the elevated price of oil. We also get the press conference, which is more important than the actual decision, as it lets us know what the Fed is thinking for the future and just what inflation is looking like. If the Fed signals that inflation looks like it's going to be sticky and a problem, then I would wager that the 10-year yield is not going to come down. So, we will be watching that Wednesday, March 18th, like a hawk. All right. Then Thursday, March 19th, we have unemployment claims, new home sales. That'll be good to watch. All right. Anything interesting next week? Manufacturing PMI is interesting. And that's really, I think that's probably it for what's pretty interesting. Like I said, 6.11. What a bummer. We were down below sixes, 5.98. Now, keep in mind, this is just the average 30-year fix, right, on applications. So, you could still see some lower, some high fives for the interest rate. This is just the average across the U.S. But it is a bummer that things ticked up. And, the interest rates have gotten worse since this whole debacle happened. And that's about it. So we will keep an eye on oil. We'll keep an eye and see what inflation's looking like. And Wednesday will be very telling. So that's all I got for you this week. If you have any questions, reach out to us at 877-TEAM-MBL or visit us at www.mortgagesbylinda.com. Have a great week, everybody. Bye.